We're live.
Awesome, awesome. All right, if you want to go ahead and pull up the PowerPoint and then we'll do
And
our
do just that. Let's share screen and let's get going. Okay, I did it.
All right, can you go back to the title page just one quick second? So our title for today's webinar is Credit Card Debt Management, Enhancing Your Credit and Your Finances. I was just on a webinar, or excuse me, on a group chat, one of the Facebook private groups, and I saw that a lot of people are struggling in this area where they may pay off their credit cards and then get right back into that situation, whether it be because of medical issue that happened or divorce, a number of things that happen in life. Obviously, we have our ebbs and our flows, ups and downs, the roller coaster of life. So I'm really, really excited about this webinar that we can kind of present some tools to help people in those situations. So I will go ahead and introduce ourselves and we'll jump right into content. I will say, we'll go ahead and introduce myself since I'm talking. I'm Alicia Alt. I often go by Allie. I am a credit expert in this field. I also have some history in the lending and real estate industry. Been doing this for about 21 years now, and I'm really excited about this content. It's one of my favorite. I got a lot of favorites, but this is one of my favorites. People struggle in this area. I also think that we have defined a really good strategy with Credit Score Pro on how to effectively tackle debt while at the same time improving your credit score. And so we're going to show some different philosophies on how to manage credit debt. And then we're going to show you how Credit Score Pro has revolutionized that. But I'll leave it to my co-founder, Ivory Becker, to introduce herself.
Yes, my name's Ivory Becker. We do these every Thursday, so you've probably heard us introduce ourselves a million times if you come every week or you watch these on the not rerun, the recording. We both have a long background in credit, in lending, and everything around finance. So with that being said, we know the importance of having that financial literacy, but being able to seek out resources that can help you with making financial decisions. So I'm going to leave it at that. And we'll just jump right into the agenda for today. So we're going to go over a variety of topics, and we're going to do our very best. If you've been to one of our events before, you know we like to talk. So we're going to do our best, keep it nice and condensed, and always feel free to comment, ask questions. You can unmute yourself if you're live. If you're on YouTube or Facebook watching, just go ahead and use the chat for any questions that you have. And then if you have any recommendations for future topics, put them in the comments section, put them in the chat, and then we're happy to make new webinars. Again, we're here every single week and we're here to serve you. So today we're going to be talking about why credit card debt is important, why managing it's important, the different techniques for paying off the debt, what are the most effective methods, how to reduce that financial stress that comes with credit card debt, and then how to manage credit cards from a credit score perspective. And then we will want to look at what is credit utilization, how should we be framing our mind around understanding credit utilization, and then finally we're going to interweave how Credit Score Pro can help you with all of these things that we're talking about today. So Allie, I'll let you take it away.
Okay, so first we'll just talk about why is managing credit card debt crucial. I don't think we have to really tell you. You already know, especially if you are currently dealing with credit card debt, but obviously just high level, it increases stress and anxiety when we have credit card debt. We can even say there's a higher divorce rate for people who have financial debt, right? That can cause that. Lower credit scores, obviously, which just makes that problem even bigger. Higher interest rates, usually also a part of the credit score that causes that. And so when we improve the credit score and we have financial freedom and we have reduced financial stress, we get that. I'm sorry, I just entered someone in the thing, so excuse me. But
I can admit
we have improved credit scores and financial freedom. It does reduce that financial stress. We are happier people, right? I mean, I think that goes without saying. So we're hoping today that we can show some different ways that you, if you are having a credit card debt problem, or even debt in general, we say credit card debt, but just any general debt, how can we improve that situation so that you can improve your life overall? All right, how improved credit can open financial opportunities. Obviously, you get access to better loans and rates. That's a no-brainer. Anybody that's seeking a home loan right now knows that if you have a higher credit score, you get a better interest rate, which means obviously that you can qualify for a larger home or loan amount, I should say. So it gives you more opportunities there. Increased credit card limits so that you have more flexibility in managing your finances, and improved employment prospects. So I know this sounds weird if you haven't seen this before, but your credit and your finances can hinder your ability to get employment. We're seeing that more and more widespread at this point in time. All right, so we're going to start out with practical tips for budgeting and reducing those expenses. So we'll start there and then we'll dive in a little bit deeper. I'm going to let you talk about creating a budget. Just so you guys know, on my perspective, I hate budgets. I call it the full-time job, but it is essential that you know where your money's going. And so I'm going to let Ivory kind of talk about this budget part.
So I think the importance of creating a budget is really, I look at it as a starting point. It's the knowing where am I beginning? Where am I at right now? Because so often nowadays we have so many subscriptions, subscriptions to everything, and you may not even realize it because some of these subscriptions are $5 or $10, and it doesn't seem like a lot until you look at it in front of you. So whether you want to write it down on paper, use a spreadsheet on your computer, it really doesn't matter, but just laying it out in front of you and visually seeing something can really change your perspective in understanding where is your money going. And then what I personally like to do is I like to categorize everything. Okay, I just lay everything out. Where's all of my spending? And I'll look at about 3 months worth of my spending, 2 to 3 months. I think that's a good time frame. And say, okay, how much am I spending on eating out? How much am I spending on coffee? Because I drink a lot of coffee, so I like to separate that out. And then how much am I spending on my actual bills, right? Whether that's debt that shows in the credit report, whether that's utility bills, but just breaking it all out. And then the required items, I keep in one category. The not required or the discretionary would be another term for it. I keep in another category. And then I decide, can I really afford all this discretionary spending? And if I can't, what can I live without forever? What can I live without right now? And what can I not live without, even though it's not necessarily a required spending item? Because realistically, we have to live life, right? Like, we can't be so strict that we never spend any money, that we are just, it's like a diet. I think that's the best way. If you completely restrict yourself from having all bad foods for you, you're gonna cheat, and eventually you're gonna cheat a lot, right? So I guess I like to make everything healthy or a happy medium, if you will, but starting with understanding where you're spending your money, categorizing it, and then realizing, okay, here's what I can live without and how much am I willing to spend on those discretionary items. That way I can then start paying down things like those higher credit card debts, right? If you don't have enough room in your budget to pay your expenses, you have to cut something out. I mean, that's the reality. It's a hard truth, but it's the truth. But again, we have to have that starting point. So I think a budget doesn't necessarily have to be forever for everyone. For some people, it may need to be, but it does need to be there in the beginning so you can see where are things going. And then on a monthly basis, look back, where did I spend my money? How does that compare to my plan? And I recommend doing that at least for 6 months to a year when you're getting used to trying to pay debt down. That's what I recommend. And then on a weekly basis is when you go back, look at what you've spent in your bank account. How does that track with getting towards your goals, etc. So that was pretty high level, lots of information. But Allie, what are your thoughts? I know you may have philosophy.
Yeah, no. I think what you said, like giving yourself the realization of what you're actually spending. So I had to do this in college. Early in college, I had to do a personal finance class, and it was an eye opener. They had us for 3 months track all of our expenses. Well, one of the funny things was in class, the professor at the time was said, I'd love to see what you guys spend on pizza. And I out loud in class said, well, that's a no-brainer for me. I don't like pizza. I don't buy pizza. Okay. So I did this 3 months of tracking, and I don't remember the exact dollar amount, but it was in the hundreds of dollars a month I was spending on pizza. Now, remember I said I don't like pizza. I was buying it for my kids and for other people to, and I didn't even realize I was doing that. And then I was like, hundreds of dollars a month on pizza? What am I doing? And so I just tell that story because we sometimes think we know where our money's going until we actually look at it, and we're looking at our bank statements and our credit card statements and all this, and we're like, wow.
Mhm.
Um, I was at one point getting my eyelashes done. If you guys have ever done that, that's a very expensive monthly bill that I didn't realize was that expensive until I actually looked at it on paper. So I think it's an eye
Right.
opener. I think it's essential that you do it for sure. I call it the spending tracking form. Write
Mhm.
down everything you spend, then categorize it. I really like to use the fancy words, but let's just say needs and wants.
Okay, fair enough. Neither one.
That's me.
I personally like to do this at least once every 6 months. Not crazy, crazy, but I want to see, oh, is there something I have on auto pay that I forgot was on auto pay? Or was there something I meant to like Amazon Prime? Okay, sometimes I'll get the Paramount Plus subscription temporarily, and then I forget that I was only going to use it to watch one show, and then I never canceled, right? So I like to do it every now and then just to see.
Yeah, I think it's important. I mean,
Where's
if
my oopsies?
could, have a day at the end of each month just to sit down and look at their stuff and see what they're doing, that would be optimal. I know life gets busy and it's hard, but this is very important just to see what are you actually doing. That's a big start because you might find money in that you can take out of your spending and then be able to use that on paying down that debt. All right.
All right, let's talk about credit cards in your credit report.
Awesome. Okay, we're going to managing credit cards to boost your credit score. So obviously we can think of some very important things. Obviously paying your credit cards on time is going to be important. Keeping balances low. It helps diversify credit mix. So if we have a credit report and we just have loans on it and we don't have credit cards, we're not going to get the optimal boost to the credit score that we would from a credit card. And then, of course, we want to limit new credit applications and closing aged accounts. So I just high leveled that, but I'm going to let Ivory kind of dig into each one of those categories and we can go from there.
Sure. So credit cards are one of the most effective ways. There's many important factors. That's my caveat, but they're one of the most effective ways to impact multiple aspects of what makes up your credit score, right? So I think what's important to realize is, let's say you have high credit card debt right now. Let's say 6 months, year, however long it is, doesn't matter. You get out of that credit card debt, don't be afraid of credit cards. Don't just stop using them altogether. They are very important to helping improve your credit score. 35% of your score is payment history. Just keeping those cards open and active allows you to impact that 35%. 30% of your credit score is credit utilization, which we're going to look at on the next slide, your balance versus your credit limit. So just those two factors, having a credit card now just impacted 65% of my score. That's huge.
Yeah.
Now, when we look at age on a credit profile, the older the accounts on your credit report, the better. That's another portion of your credit score that you can impact. And then credit mix, another portion. So the credit score algorithm wants to see that you can use different types of debts effectively. Again, a credit card is a type of debt that's extended to you, type of credit that's extended to you, right? So just by having that credit card, 1, 2, 3, we recommend 3, open and active accounts, you are going to impact your credit score positively in so many ways. Now it's all about, okay, doing that responsibly, and you can get to that point. We know life happens and it can cause increases in using the credit card. So ultimately, we want to keep balances below 20%. If you have a limited credit profile, I do recommend keeping your balances even lower. But we'll look at that a bit more on the next slides as well.
Yeah. And I would just like to add into when we talk about closing aged accounts, Ivory talked about, the age of your account really matters. It's very, very important to get credit cards. And Ivory said 3 is what we recommend. We absolutely recommend 3. There's a lot of reasons behind that, but we'll just leave it at that. But 3 is a recommendation. but you want to keep those cards open and active forever. So be careful about what cards you get. You don't want to be getting cards with an annual fee unless you're okay with paying the annual fee. Like I have a
Right.
Delta credit card that has a $99 annual fee. Completely okay with that because I don't have to pay for baggage when I go to on Delta. But if it's a benefit for you to pay the annual fee, great. But if it's not and you're just getting a card because you have a low credit score, there's other ways to do it where you don't have those type of cards and get stuck with the annual fee, especially those that have an annual fee plus a monthly service fee. But you want those open and active forever. If you're just relying on loans, they eventually will close, and now you no longer have this this line of credit to show that you have a longevity. So I think that's important.
Yeah, why don't you just go ahead and segue right into utilization?
That's it. Credit card utilization. We talked about that. We recommend that your balance doesn't exceed 20% of the utilization. So an example here that Ivory has on the slide is if you have a $200 balance on, okay, if you have a $200 balance on a $10,000 credit limit, that's 20%, right? Let's give a little scenario. Let's say you have a $300 credit card, because a lot of people have that. We wouldn't want that balance to go over $60. Anytime we go over $60, we're going to see a decrease in the credit score. So one of the ways that I like to talk to people about credit, managing credit, is number one, that credit limit utilization rate is based on what your balance is at the time the credit is pulled. There are a lot of times people say, well, I pay the credit card off at the end of the month. So I don't care about that it's above 20%. And that's not how credit works, right? When that shows up on your credit report, that balance, anytime that balance, whether you pay it off at the end of the month or not, shows above that 20%, you're going to see the hit to the credit score. So people will say, I feel like my credit's a roller coaster. And typically that's because balances fluctuate up and down. So if we think about credit cards, that it's not an extension of our income, but it's used to improve our credit situation, we're going to be much better off than someone who says, well, I got this credit card and I have a $10,000 credit limit. I really want this flat screen TV. I'm just going to charge it on this credit card and not thinking about the consequences of the action. So I like to tell people, have that mindset that credit card is for building credit, not for an extension of your income unless it's an emergency situation.
Right. Exactly. I think you already talked about most of this.
Yeah. I think we should go over use credit cards regularly and responsibly. We talked about the responsibility just now. Regularly really is important because if you're not using it and making small purchases on a regular basis and or paying a balance off, once it becomes inactive, meaning you have no activity, you're not paying a balance, you haven't used the card. We usually say about 3 months span of time, it becomes inactive. It's no longer now improving your credit score. I'll give you an example of a client that did this. So we needed to build credit. I got him a secured credit card and he would go and use the secured credit card. The bank that the secured credit card was from was across the street from his house. So once he used it, he also ran over to the bank and paid it off. And I was wondering why his credit score wasn't improving. And what I found is exactly that. He was using it and then paying it off immediately. So there was no activity showing up on the credit report. So you really do need to use the card. And then once you get the bill, pay it off. If you have a balance on it and you're making payments, that's activity, that's fine. But don't let that credit card go 3 months or more without some kind of activity because that would become inactive and it's no longer helping to improve your credit score. And a lot of people don't know that.
Okay, next, let's talk about defaulted credit cards.
Can I stop just 1 second? I know we got some people on Zoom and I know we got some people that are on there live. If I could just stop for a second, do you feel like, if you guys want to answer, is there any room that on the open and active credit cards that we could spend a moment on longer? You have any questions about that to how that improves your credit score before we go into defaulted? If you do, just feel free to chat that to us and we will answer that as we go into defaulted.
Okay. And we're gonna go into methods of paying down credit cards in a bit here too. Just so you're aware. So how credit card charge-offs affect credit. It's not uncommon to hear the question, I'm sure for you too, Allie, what is a charge-off? What's that even mean? So a charge off occurs, as it says right here on the screen, when a creditor writes off your debt as a loss. So after you go so many months without being able to satisfy the full payment that's due, the creditor, your credit card company, determines that you're not going to be able to make your payments. And so they close the account and they make the entire balance, that entire balance you owe, plus any interest and fees they've charged, due and payable in full. Usually that's at about 180 days. That actual charge off date time frame, can vary depending on the creditor. And they'll mark it on your credit report as charged off. And you do still owe that money at that point. Just because it's charged off doesn't mean that that balance is no longer something that you are required to pay. Anything you would like to add to that, Ally?
Yes, I do want to add something.
Sure.
Because people get confused about the word, they might see on their credit report, and sometimes they're used interchangeably on the credit report, charge off and written off.
Mhm.
Charge off and written off are two very different things, but sometimes they are on, if you're looking at a credit report and it says written off, it might not truly be written off. It may be just charged
Sure.
off. It's the wrong language. Like I said, it can be, but they do have two very different meanings. If a creditor charges off your debt, that means it's a collection. Okay, essentially you are going to have to pay the creditor that whole balance. That's what they're hoping for. Obviously, you possibly could settle it, but it's still a debt. It does not mean you don't owe it. I get this call all the time. It's charged off. I don't owe it. That's not true. You absolutely 100% owe it. My favorite one though is people see written off and they go, well, I don't owe this. I got, this is written off. So that, they just let it go. No, that's not true either. Written off means that that creditor got to use that as a deduction from their taxes, but they're going to send you a 1099-C, which says, we wrote this debt off of, let's say, $5,000. You have to take that 1099-C and claim that as income on your taxes. Okay, so they're taking it off from income on their taxes. You're adding it as income on your tax return. Two things about that. If I'm charged off, I have the opportunity to go to that creditor and settle that charged off debt for less than what I owe.
Mhm.
An account is written off and I get that 1099-C. Written off accounts cannot be settled. Okay, the creditor cannot settle written off accounts. Remember, they use that as a write-off for themselves. They gave it to you as a taxable debt. So just so you know, a lot of people are like, I want a written off thing. No, you don't. You're going to pay taxes on it, and you still are going to have it on the credit report with the full balance owed, and they will not settle. Okay, so I just wanted to make sure everyone knew the difference. You still owe it no matter what it says. Okay.
And I think you earlier brought up a solid point, right? It's a collection, it's technically a collection once it is charged off. But what's important to understand when we say collection, it's being collected on internally by that creditor. So there can be third-party collection companies where your creditor can hire that third-party collection company to call on behalf of that credit card company to try to collect. That creditor still owns that debt, it's still their debt, or they can choose to also sell that debt to a debt buyer or a third-party collection company that's a debt buyer, right? And now that debt buyer owns that debt. So I think that's kind of an important distinction to make, and there's a lot of confusion around that. In the future, we are going to do a webinar that's just on collections in general to help make sure there's clear understanding there, because we know there's a lot of myths and misinformation, confusion out there regarding that. So a charge off, how long does it stay on the credit report, Ally?
Charge off from the dated original default. So your first missed payment. So not the date that it actually charged off.
And what if it's sold to a third party collection agency? Does that time frame restart? Exactly. That's another misunderstood portion of charge offs and collections that I thought I'd interest.
Yeah, that's important to know because you might see on your credit report that the collection company is saying it's opened on a new date. That date should have reflected the original date of default, but it doesn't always do that. So that's important to know.
So we're switching. Oh, sorry. Go ahead.
Just before we switch from this screen, I think, are we done with charge off? You feel like
Not yet.
Okay. I'll let you finish. We did have a question in the chat. I personally.
Oh, go for it.
So we had a question, why do we need 3 credit cards? The answer to that is that most lenders want to see 3 open and active, what we call trade lines, AKA accounts. Those can be any kinds of accounts like credit cards, loans, any kind of positive accounts, I should say. However, loans do close at some particular point in time. So we're recommending credit cards because they can stay open forever. And we talked about how the length of credit history is really important. If loans close, they no longer help your length of credit. They're no longer a part of your credit score. So that's why credit cards are important. And that's why 3, because most lenders require and or want to see 3 open and active trade lines at all times. Okay. All right. Sorry. We can go back.
No, you're good. I forgot where I was gonna segue with charge-offs, but I guess for the most part, there can be a lot of complications once it comes to an account going past due, being charged off, dealing with collections. Part of the opportunity with Credit Score Pro is really taking that away from you, having to have that knowledge base. The system is going to have that full understanding of how everything works. So some of your options when it comes to dealing with the charge off, we already talked a bit about being able to negotiate and settle with a creditor. This can be beneficial too, because it will prevent it from being sold to a third-party collection agency. So what another thing that's important to understand is if your creditor sells that debt to a third-party collection agency, that third-party collection agency has the ability to report that collection on your credit report. And now you have one hit on your credit from the original creditor, and then another hit on your credit from that new collection agency that purchased the debt. So you're going to see that negative account impact your credit twice. So if you have the ability to settle on that account before it can get sold, that can be beneficial. There are other considerations to keep in mind before necessarily approaching settlement, depending on timelines and a whole bunch of other factors. Ali, do you want to get into any of that, or do you think we should save that for another webinar?
The only thing I wanted to add to that is that a lot of people wait to start fixing a problem when it's bad, when it becomes a charge off. A lot of creditors have internal policies of financial hardship. Typically, have to be at least 30 days late to qualify for any of those programs. On that group chat thing I was telling you guys about, or Facebook group, private group, one of the people that went on there, they worked really hard, got their debt paid off, and then they got more debt because of medical. These creditors, especially if you have a medical issue, that's what I call the trump card, and you call them, you're 30 days late, and you say, hey, I'm having problems, I have a medical issue, blah, blah, blah. A lot of times they will do some amazing things as a financial hardship program. And sometimes they'll even like freeze your account where you can't use it anymore, but then reopen it once you get back on track. I've had clients call and they got 0% interest for 5 years. 1% interest, 5% interest. So we take this credit card debt that was at 29%, or now we're seeing them at 34.99%, go down to a really low amount because you made that call. But don't try to make that call once you're charged off. They're not gonna, create a plan for you.
Yeah.
So if you can get ahead of the game, you're going to be better off than waiting for this situation. And I think people don't know that. They don't know the creditors can help them. So they just bury their head in the sand and they hope that, someday it'll all pass over. Right.
So important. Such an important aspect to bring up. Yeah, love it. We should have had a whole slide just on modifications. So if you do already have the charge off, it's on your credit report, your credit score has been damaged. Like I said, you have that option to negotiate, set up payment plans with that original creditor. There are some factors to consider there. You have the option to dispute the accounts as well. So with disputes on the credit report, you're looking for errors, inaccuracies, obsolete information. There's a whole host of things that you can look at. And you also don't want to forget to rebuild your credit. Just because you had credit damage doesn't mean that you should ignore your credit forever now. There is a lot of opportunity for affecting all of those factors that make up your credit score that can help mitigate the damage that was done from that charge-off account. And you can rebuild. You're not stuck with bad credit for 7 years, even though that charge-off stays on the report for 7 years if you do nothing.
I think that's important. And when we talk about dispute inaccuracies, I typically will require, talk to my clients about disputing any and all negative items on their credit report, including the charge off for inaccuracies that could be there, because oftentimes the credit report's full of those. But the other reason on charge offs that is really important is if they can come back and verify the information they're reporting. Sometimes they'll send you that documentation. Here's the verification, prove it to you, which you need to have that proof of what happened. But a lot of times they'll say, but here's the evidence, but we're willing to settle for XYZ. And I've seen situations where I had a client that had a $12,500 American Express credit card that settled for $1,500. You never know. So it's a good opportunity to possibly get settlement offers directly from them. Okay.
Feel free, you can keep going.
All right, benefits of using Credit Score Pro with charge-off accounts. Guys, Credit Score Pro, obviously we're all here because of Credit Score Pro. It is our AI software that we've created. But remember that Credit Score Pro will do automatic dispute process for you. I highly recommend that on any negative debts, inquiries, things like that might be hindering your credit score. And we do provide real-time updates. So inside of Credit Score Pro, if we did a dispute on XYZ, it's going to come up when we do the next review, and it's going to show you exactly what was removed and or updated and changed from a negative to a positive. We do have rebuilding options inside of Credit Score Pro. And even without the Credit Score Pro software, we have a page on Credit Score Pro dedicated to rebuilding. And these are rebuilding tools that we vetted. And what I mean by that is you're not going to get caught up in a lot of these pre-approved offers that I know you're getting in your mailbox, AKA First Premier, that are not what I would say the type of credit that you should be applying for. Okay. So we vetted these. A lot of them are either free or low cost. So they're not having, high annual fees and monthly service fees and things like that. So you have access to that. And then we have on our Facebook page, we have community support and forums. So all these things can help you with these charge-off accounts. On the screen that Ivory just switched off of, when you're inside of Credit Score Pro using the software, you actually get to decide on what your goal is, your specific goal for your credit. When you go on there and you select your goal, Credit Score Pro is going to produce a plan for you specifically tailored to your needs. So if it is a situation where you need to rebuild credit, you could go to the credit building page, but Credit Score Pro will give you the specific ones directed specifically for you based on your goal. So I think that's vitally important. You don't want to take guesswork when it comes to credit. You really want to have a plan, a detailed plan that lays out exactly what you need to do. You're going to feel a big weight lifted off your shoulders because you can be like, okay, I know exactly what I need to do. I don't have to guess on here. I won't make the wrong decision. I have the ability to make the right decision by having the plan. All right, so you guys probably already heard of a bunch of different ways of paying down credit card debt. We're going to go over a few of them, and then I'm going to tell you how Credit Score Pro revolutionized these ideas and made them even more powerful. But Ivory, I'm going to let you talk about the different methods, if that's okay.
Oh, you want me to talk about them?
I'll let you talk about the methods, and I'll talk about the revolutionized way. How about that?
So yeah, that sounds good. So when it comes to there's a lot of methods out there you may have heard of for paying credit card debt, and everybody argues that they have the right way, the right method. I think all of these tools are good tools. They're good, valuable options. It just depends on what your goal is. So the avalanche method is one method that's very focused on interest. So they have you start with paying off your debts that are the highest interest rates first. And the whole point is to pay the least amount of money over that time frame to pay your debts, right? You pay less interest if you're getting rid of the highest interest first. So that's the avalanche method. The snowball method focuses on paying the smallest debts first. So what happens with the snowball method would be, let's say I have 3 credit cards. My payment on the first credit card is $100. My payment on the second credit card, all 3 credit cards, $100. I pay off one credit card, and then now I put that $100 from the first credit card I paid off to the second credit card. I pay off the second credit card. Now I put the $200 to the third credit card, right? So every time I pay off a credit card, I'm just adding that payment from the prior credit card to the new one. And it's a snowball effect where I eventually pay things off faster and faster.
This is probably the mostly wide known method.
Yeah, absolutely. Absolutely. And then next we have balance transfers. I have heard so many people using balance transfers as an option to pay debt off fast. The theory behind the balance transfer is I transfer my balance from this credit card to this new credit card that I got that has 0% interest. And during that 12, 18, 24 month 0% interest time frame, I'm going to pay off all my debt. How many people actually pay off all of their debt during that introductory period? Not very many. And a lot of people just end up in this vicious cycle where they keep transferring and transferring, but never actually pay their debt off. So when utilized properly to where, let's say you transfer to that 0% and it's 12 months, you calculate what's 12 months worth of payments to pay the whole thing off, it'll get paid off. But not a lot of people have the discipline to actually pay it off during that 0% APR or 0% interest time frame. So I caution people on these. Often they do also have balance transfer fees. So you want to look out for that fee. A lot of times it's like 5% is the balance transfer fee. So you may have 0% APR during that set time frame, but there was a balance transfer fee. Some cards will add the interest if you don't pay off the whole balance at the end of the promotional period as well. So all that interest that was suppressed or not added to your account gets added at the end. So you do want to make sure you're looking at the terms. So this can be an option for someone who is very disciplined, but I have some more cautions with it.
Mm-hmm.
And then we have consolidation loans. So consolidation loans, I want to clarify what a consolidation loan is versus a debt consolidation company. So let's start with a consolidation loan. A consolidation loan is when you take out a loan that pays off your other debt. Could be all your credit cards, could be your credit cards and I don't know, a personal loan. It is essentially one loan that pays off your other debts. You now pay that loan on a monthly basis. And by your final payment, that last payment that's due, all of your debt is paid off. So consolidation loans can be a great option if you have higher credit card utilization. Once that balance is moved from the credit cards to a loan, you're going to see a jump up in your credit score because you're not negatively impacting the credit utilization ratio, which is very heavily focused on revolving debt or those credit card payments. So that can be a great option. But my caveat to that is your score does have to be at a point to where you can qualify. So oftentimes consolidation loans are utilized once you get your score a little bit higher. So you may have to pay down some credit cards before you can do a consolidation loan on the rest of your cards. Let's see, what else am I forgetting about? The comparison. A debt consolidation company is often calling you saying they can make it so you pay just one monthly payment to all your debt and you're not going to have to pay the full balance on your credit cards back. They're going to reduce the amount that you have to pay. I want to caution you with doing this because it is very different than this consolidation loan we just discussed. What they are doing is they are not paying your creditors. You're paying them on a monthly basis. They're taking the funds you're paying on a monthly basis and they're setting it in an escrow account to sit there until your creditors agree to settle for less on the balance that you owe. So what happens when they're not paying your monthly payment? Well, your account goes past due and it eventually charges off, and now your creditor is willing to settle for less. So the exchange for paying less than you owe on those credit cards is the negative impact to your credit score. A lot of people who sign up with the debt consolidation companies, I call debt settlement companies because that's really what they are, don't realize there's going to be a negative or an adverse impact to their credit score in exchange for that program or that service. I'm sure I'm missing something there, Allie.
No, I just have a tip on this.
Yeah.
We talk about consolidation loan, or maybe we're consolidating with the balance transfer, or maybe we're trying to get home equity line of credit or cash out refinance. I hope you're not doing that now. But ways to get debt consolidation. But here's the thing that I see happens most often. People seek this help after they're so far gone and their credit score is so diminished that they can't qualify for those things. So I think it's really, really important. And I think that segues into this.
It does.
If you know a problem is going to happen or may likely happen, it's a good time to go ahead and get that personal loan to safeguard you. Even if you don't necessarily end up using it, you have it to safeguard you in the event that a problem does proceed from whatever life event may happen.
Let me stop you there real quick. Allie's saying personal loan because a true debt consolidation loan is a personal loan. So I just want to clarify that.
Great, thank you. Yes, it is a personal loan. You're personally guaranteeing that. You could get one that's a home equity and it is a personal loan, but that's got collateral behind it, right?
Mm-hmm.
Cash out refinance has collateral, but most often people are getting personal loans. It's basically you're signing your name and you're saying you're going to repay. There's no collateral based off of that. So I just caution people because I see it too often. So I was just having a meeting with a young lady who's going through a divorce. Financials have been totally disrupted, right? So now she's really concerned about paying her bills. Her credit score is in the 800s. And I told her today, you're going to go and call and get a personal loan. Whether you end up needing it or not, you're getting it today because you're going to go ahead and pay off all your credit card debt that you may or may not have been able to pay. Because we need to keep your score high. We need to have the funds available in case, because we already know there may be a problem brewing. So
may I add to why that makes sense too? Why we're moving credit cards to an amortized. Actually, let me just ask you, why are we moving credit card debt to an amortized payment? And we can explain what amortized is if you'd like as well.
There's two big reasons. I'm going to high level this, but there's two big reasons why you would do that. Number one, credit card interest rates tend to be much higher than a personal loan. Okay, especially if you're able to get a personal loan that's backed with some kind of collateral, then it's a lot cheaper. Or home equity line of credit, which is tax deductible interest. So number one, you're going to be financially better off by doing that. Number two, amortization is different. You actually will pay that debt off faster because the interest and the way that it's calculated is different. So there's a lot of benefits to doing it that way. If you were holding on to credit card balance debt, you need to be looking at a personal loan if at all possible. I would suggest that. But I think
most credit cards are designed for you to pay them off at the soonest 15 years, but often 20 years. They're not designed for that minimum payment they give you to help you pay off that account. I think that's a really important fact that a lot of people aren't aware of.
Yeah, like a forever loan.
Yeah.
But then be cautious because I've seen people get the personal loan to pay off the credit card debt, and then what do? They go and charge up all the credit card debt again. Yep. And some not in their control because life situations happen. But a lot of times, I mean, if we were really deep and honest, even with life situations, we're still getting our hair done, our nails done. We got Netflix and cable and internet and all these extras that we may or may not need. And so taking a really, and we began with that, taking a really clear, deep, honest look at what you're spending your money on is realistically the first step.
Yeah. I don't know if we covered all of it there. Actually, there's a little more to talk about there. I'll let you keep going.
Oh, I'm good. What do you want?
Okay. Strategy wise. So one of the things I want to mention with this is people argue, hey, do the snowball, do the avalanche, do all these methods. Sometimes the combination is what's the right method. So we may start with a snowball in a way, right? We look at the credit card with the lowest credit limit and the highest balance. So if I have a $500 credit card that's maxed out, $500, I'm going to pay that off first because the credit utilization ratio is looking at my credit limit versus my balance, right? On that individual card, it's all about the ratio. So that maxed out $500 card and that maxed out $5,000 card are both affecting my score negatively because they're both maxed out. They're both 100% utilization. It's a heck of a lot easier to pay off that $500 card first. Now all of a sudden my credit report's gonna, or pay down, pay it under 20%. My credit card utilization on that card is gonna be updated now. And that's gonna cause an increase in my credit score. Focus on a couple of those smaller cards first. You're gonna see that positive impact to your credit score. And then all of a sudden you may be able to qualify for that consolidation loan, right? Because you do have to get your scores to a certain point to where you can get the loan. Let's say you get there now, and that consolidation loan, they're quoting you 12%, they're quoting you 15%. And you're like, I do not want that. That seems like a really high interest rate. It is, but it's a heck of a lot lower than that 29%, that 30%, whatever you're paying on your credit cards, and you're eventually going to pay it down. And you may be able to refinance it later to something even lower, right? Because once you shift all of those credit cards over to that loan, you're going to see a jump in your score. You're going to look better. So I think sometimes we need to take it step by step. And really think about the plan, right? So anyway, that's it. That's all I got.
So Credit Score Pro is going to help you in that fashion, right? We talked about the different ways of paying debt, but Credit Score Pro does have a little bit different take on that. So we look at Avalanche, the Snowball, and Ivory was segueing into that. If I have 3 credit cards, Credit Score Pro is going to look at those 3 credit cards and it's going to say, okay, we're in credit card debt. Which one of these cards is the easiest to pay down to, say, the 20%, so we get a boost in the score? So we're looking at what are the first ways to get a boost in score? Remember that if we have a high credit score, we get better opportunities, right? So I think it's really important for you guys to know that level of, very, very important to get those credit scores up. That Credit Score Pro is going to help you in that fashion. So it's not necessarily the Avalanche process or the Snowball, it's what things can we do in paying down this debt to improve the credit score faster. Okay. And then that opens up the opportunities for, say the debt consolidation loan and things like that.
Yeah. And there are resources and tools out there. Of course, like Credit Score Pro is going to be extremely focused on your credit, your debt, how to manage it. It can be very helpful to pair that with a budgeting app or a budgeting tool, like You Need a Budget, for example. And we have Smart Credit, which is integrated within Credit Score Pro. That's the credit monitoring provider. They're going to tell you the best days to make payments on those credit cards once you get those debts paid down and you're in a good spot to where it's going to have the biggest impact on your score. So the combination of these tools and resources now can really, really just propel you forward. And I don't know if I missed anything. Let me go on that last slide. We talked about this already. Create a plan, use the resources that exist to help you with that plan. And like I was mentioning, one task at a time, create a path. And it's when you break down a big goal into bite-sized pieces, it's a lot easier to achieve the goal. So what does AI credit technology look like? We've talked about a lot up until this point. So Credit Score Pro is really there to help you with managing that credit card debt, getting it to a place where you can breathe that sigh of relief, but then still utilizing credit cards in a way that can help you get and then maintain a strong credit score. So Allie had mentioned earlier the tailored credit improvement plan, and you have listed a lot of features throughout here. It's goal-based. It's going to tell you the best things to do to get that high credit score and maintain it, but also it's going to let you know, hey, let's say you paid off all your credit card debt now, you paid off a card or 2. If that card becomes stale, it's not impacting the score algorithm anymore. It's going to remind you to use that card. Throw your Netflix subscription on there or something of that sort, so you're not overusing it. There's a whole bunch of components within Credit Score Pro, and we'll look at that right here. So if you were to sign up for Credit Score Pro, first of all, the software itself is completely free. The only thing you pay for is access to Smart Credit, so we can get the credit report, right? You cannot analyze a credit report without a credit report. So step 1, get the credit report. So the AI is automatically going to analyze the raw data on your credit file, and it's going to look like this. So on the right side of the screen, that's the raw data. That's what the credit report actually looks like before it is made to look all pretty, like you see on the left side of the screen. So the importance is there's a whole bunch of information there that you're not seeing on the left side of the screen. So the AI is able to read through that information. And that's so important because if you do have a missed payment, a charge off, any negative information on your credit report, the AI is finding those errors and those issues so you can dispute that information. So you'll be able to click and choose the negative accounts, and then AI is going to suggest the best dispute for you. You do have the option to change the information in there. We don't recommend it. AI knows what it's doing, and it's constantly updating and changing based on the success and failures of every dispute used by every single user. So thousands and thousands and thousands of prior history it's able to utilize. The only time that we do suggest changing this reason right here is identity theft. AI doesn't know if it's identity theft, right? So you'll change that drop down, choose identity theft, and go from there. And then, but wait, there's more. You will print and mail the dispute to the credit bureaus. If you don't have a printer or you prefer not to print, even though that is the preferred recommendation, you can use our integration with Mail-IO, which will mail your credit disputes to Equifax, Experian, and TransUnion for you. The nice thing too is every month your credit report is automatically going to be imported into Credit Score Pro from Smart Credit, and it's going to compare last month's report with this month's report, tell you what's been removed based on your disputes, let you know what types of new disputes we need to do based on changes on the report, and all that fun stuff. It's going to happen all automatically.
It will email you your action plan.
Yeah, that too, which we will look at in a moment. So disputes we know are just a part of the process, right? We talked about a whole bunch of the other factors throughout today. So we want to make sure we're optimizing these good accounts you have on your credit report. And we also want to see, well, where are you not affecting that credit score algorithm, right? What if your cards are stale? What if you don't have any installment accounts in your credit report? What if you have no credit cards? And on and on and on. What's missing from your report that can help improve your scores based on your goals? And the important thing about choosing the goal is there's a whole bunch of different credit scores that are used, right? If you're buying a home, home lenders are using one type of credit score. If you're getting a car, they're using a different credit score. So picking the goal allows that action plan to make sure it's being developed for that credit score algorithm that's going to be used to qualify you to buy a home or to qualify you to get a business loan, etc. And this is what that action plan looks like. This is what's automatically updated every single month, like Ali said. As AI gets that comparison for the disputes, it also is able to see, okay, check that box, you paid that card down, what's next? Or, hey, this credit card needs to be used, it hasn't been used. I don't know, I keep repeating that one, but what am I missing here? Anything?
I mean, also green and red, like it says, okay, if you have credit card debt and you went up on that credit card, it's gonna, and your score dropped, it's also gonna show, hey, in red, you went up on this credit card and this is what hindered your credit score. Or green, almost like a congratulations, you're really working towards your credit goals. So I think that's fun. That's a fun portion of it.
And
Green,
that other,
red,
go ahead. Sorry.
No, you're fine.
I was gonna say that other aspect too, it's going to tell you is the credit building tools. We don't want you taking out debt for no reason. I want to be very clear about that. So just because your credit report says, hey, an installment loan would be helpful, there's a lot of tools out there that allow you to impact that part of the credit score algorithm without you taking out debt for no reason, right? We have these tools available on our website, but the AI, if you use Credit Score Pro, it's going to say, these are the tools you specifically need. These other tools are great, but they're not going to get you far enough for it to matter, or they may not affect your score at all. So why use them, right? But again, if you do want just access to the tools, just go to the website. They're on the credit building tab, and you can access them there. The other part that's really important is if you are here, you're wanting to learn. You want to understand credit. You want to understand how to be financially stable and to get your yourself to that point of financial freedom. So we do have financial literacy built into the platform. Please feel free to always attend every single Thursday, or every other Thursday. One Thursday on we do for professionals, the other Thursdays for consumers. But if you really want to know the nitty-gritty details, that's what this credit coaching section is really for. So this is bite-sized videos that goes into all sorts of aspects, and you'll see them here on the screen. But if you want to know everything about charge-off accounts, there's a section on that. If you want to know everything about collection accounts, there's a section on that. If you like laws, you know, power to you, there's a section on that. But it goes into all sorts of things like the myths, which I think is one of my favorite areas because there's so much misinformation out there. And then it allows you to pair all these recommendations that the AI is suggesting for your action plan with all the why. The why is the AI telling you to do this? What are the details, the background that's saying this is the best thing for you? And you don't have to be the expert on every single intricacy, right? You can let the advanced technology we have nowadays be that expert for you. We all have to play the credit game. We're in the system, right? We're in the credit system. So it only makes sense to be able to understand the rules and to have the most effective and efficient strategy so you can be as successful as possible. And that's really what Credit Score Pro is meant to do for you. It's meant to level the playing field and allow you to have the opportunity and the empowerment to get to that high credit score and then keep it. So that's my spiel. I don't know, Allie, if there's anything you want to add since I'm off my soapbox. No.
I love Credit Score Pro for that, what you just said. You don't have to be the expert to end up being the expert. It has like all the educational features in it, but then it's guiding you exactly what you need to do. And what a great opportunity to share that with your family and your friends and your kids and help them have a good start, because everyone says that there's no financial literacy and credit literacy in schools. And I'm going to agree with you. There's not, and or it's so limited and so basic that it's not even worth what you're going through. But this really gives you the full resource. So if you said you wanted it in school and you didn't get it, it's available now for sure to everybody, and it's free. Again, you have to pay for credit monitoring, but everyone, guys, if you don't have credit monitoring, make sure you have credit monitoring, especially the one that we partnered with, Smart Credit, because when you have Smart Credit, you get a $1 million insurance policy against identity theft. Guys, I don't know how many calls I get constantly of identity theft, and they have no protection. So they get $5,000 taken out of their account, identity theft, they don't have any protection, and then they're stuck out of that 5,000. It's happened to me. I know what that looks like. But it gave you a $1 million insurance policy. It also has Privacy Master, which is so important right now. When people talk about identity theft, they're thinking, oh, people are going to get in my mailbox and they're, hacking my computer or whatever. Yes, that stuff happens, but your information is being sold on the dark web and other websites. And if you ever go to like People Finder and places like that, pay for your own People Finder report and see how much information of yours is out there, from what cars you own, insurance, house, addresses, cell phone numbers. It's ridiculous information that people can get. And with Smart Credit, you can actually click buttons to remove yourself off of those sites. So just some things that I think are really important with your Smart Credit connection to get the free service with Credit Score Pro. All right, so we talked about all this stuff. We do have a Facebook page. We did have a question about, is it recorded? This is a live recorded session. It will be on our Facebook page, which is the Credit Score Pro AI. And we do also have a private Facebook group, which is the AI Credit Revolution. Okay. So we'd love for you to go in there. If you have any questions, we'll monitor that and we answer questions as well.
Yeah, absolutely.
Every Thursday.
Huh?
We're here every Thursday.
Oh, yeah, every Thursday. I thought I'd share real quick what next Thursdays is, so I had to stop sharing my screen. So next Thursday, we are doing 5 tips for lending professionals, and then the Thursday after that, so July 11th, Okay, yeah, let's clarify. So June 27th, 5 credit tips for lending professionals. And July 11th, we're skipping obviously 4th of July. And so the next one will be July 11th, navigating your credit report, essential insights. So if you really want to know how to read the credit report, how to interpret the credit report, that's the session for you. And if you want to know what else is coming up in the future, you can check out our Credit Score Pro page on Facebook. It does have upcoming events, and then so does Eventbrite. And then LinkedIn, if you're on LinkedIn, they're there too. So a couple different options for you. So if you have any questions, email us at info@mycreditscorepro.com. Or just visit us online, our website, creditscorepro.ai. There is a contact us option there too. Feel free to ask your questions in there as well. But otherwise, that's it for today.
Does anybody live have any questions for us real fast before we end this session?
Yes, I have.
Okay.
Actually, I have two. One of them you just mentioned, but I seem I missed it. I couldn't get it. You mentioned that we can search somewhere, like it's people, how they can find you, some website to know what's information on the cloud.
Yeah, if you go on to creditscorepro.ai and you get connected on Credit Score Pro, you will Credit Score Pro's features are free, but you're going to link to Smart Credit. Smart Credit has an amazing platform. That's the credit monitoring that has something called Privacy Master. And it allows you to take action to remove your information off of websites and the dark web that are selling your information. You'll be pretty surprised when you first go in there the first time with Privacy Master. If you ever go in there and you have questions on how to navigate in it, we will be more than happy to help you. But when you go in there, you might see that there's 40 different websites selling your information. You're going to be pretty surprised and a little bit disgusted.
Yeah.
But you can click on those and essentially Smart Credit will work on removing that from those sites. Okay. Very, very important. I actually recommend people go into their Smart Credit and do that once every 30 days, just to keep tabs on it.
Wonderful. Thank you for that. Another question, it's related to the credit cards. Remember, I asked the question about why we need to have at least the 3 credit cards. Now, there's something else in the opposite direction. Some people say that when you are applying for a mortgage for like buying a home, that could affect you if you have a lot of credits, even if you are not using them and there's no balances on it. Could you help me understand why?
I think there's a little bit of misinformation there in that. When you're applying for a mortgage loan, a loan officer will recommend that you do not have your credit pulled, so don't get any new extensions of credit. As a prior loan officer, I will tell you that I wouldn't want you to add new credit unless I specifically told you that it would improve your credit and that would be a good thing for you. But we want you to avoid that, because what happens a lot of times is people get an extension of credit during the loan process. And when we go to do the closing documents, we do relook at your credit. And if we see you got a new line of credit on your credit report while we're in the loan process, now we're going to have to stop everything for a second, find out why you got it, what's the purpose, what are you going to do with it? And it could complicate the loan process. And I've had people go out and get like furniture store credit cards and stuff because they went and bought a bunch of furniture for their new home they bought, right? And then now we can't the home because the debt to income ratios were affected and things like that. So it's just a wise thing if you're in the process just not to do any credit pulls unless your credit score is not good and you're getting help to improve that so that you can get approved. Okay. And if you're approved, don't do anything until after that.
So that means, like, if you have the credit cards from before, your credit score is good, and you are applying for a mortgage, this credit card, whatever number you have, it will not affect you.
Correct. Unless, like, I've seen this happen. Let's just make up a fake person. I just went and got approved for a loan. I'm pre-approved. I went and found my house. I'm in the process. I have 3 credit cards. When I got approved, I didn't have a balance on those credit cards, or at a small balance. And then in the time frame that I was going for the loan, I went and maxed out all those credit cards. Again, we're going to relook at your credit before we close that loan. that's, that may in fact get you denied. So I really say when you're in a loan process, don't try not to use your credit. You definitely don't want to get new credit. Like whatever you got approved, whatever your credit looked like when you got approved, make sure that just maintains that way.
For sure, yeah, I totally understand that. But the one that was told to me, it was really confusing. Like, if there's no balance, the credit is good, so why it will make a problem? So I just wanted to understand that, but that makes sense what you explained. Thank you for that. Appreciate it.
Very, very welcome. Yeah. Yeah. Any other questions? Well, thank you for being on our live today. Anyone that's on live anywhere, but thank those that are on the Zoom registration. We really appreciate you because we can talk to you. And we love that. We love the interaction. Again, we are here every Thursday, except on holidays and things like that, or if we're out of town for some reason. But we love these. We love the interaction, but we're always here for questions offline as well. So keep that in mind. But we appreciate you. Go check out creditscorepro.ai. I think you're going to be amazed and love it.
Thank you. Thanks a lot for all of you.
One more question I want to answer. How should I close out a credit card? I guess I have a question for you. Why would you want to? I wouldn't recommend that you close out a credit card. But if you have maybe a little bit more clarification of why you're thinking about that, I can possibly help you. In case you don't type that fast enough before we or holler it out to me. If it's a reason that you want to close it out because it has a large annual fee or monthly service fee, aka, the one I talked about earlier, we still want to look at it and make sure that's the right decision to close it out. Because if it's your longest history and you don't have a lot of other history and you close it out, that's going to really significantly reduce your credit score. So we want to be very careful about the impact of closing a credit card. But if there's no other reason of why you would want to close it, I'm going to recommend that you keep it open forever and use it once every 3 to 4 months to keep it active. Hope that answers your question. All right. Well, thank you guys for being here, and we will see you next week. Bye.
Thank you. Have a good evening. Bye.
You too.